topic and then take any questions as needed. Um, so working capital, I always like to set the stage of imagine you're buying a car and you negotiate the car price, but there's an agreement of, the car needs four tires, the car needs to have some gas to drive home, and you negotiate, a fair price for the car and the components of it. Um, the You take possession of that car and you're driving on your way home and reality hits. The car sputters, stops down the road, just 1 mile down the road from where you purchased it. Um, that's reality hits you quick. What do? You likely have to call a tow truck or walk to the nearest gas station, get a tank of gas, fill up your car, and then be on your way. Um, so the reason why I bring up this lesson is gas in a car, the tires tires on a car. This is working capital in M&A. Without these critical components, business operations halt immediately after you make an acquisition. So the lesson behind this is working capital is just as important as the price you pay for the business, the multiple you pay, the transition period. So negotiating working capital, understanding what it is, how to calculate it, how to structure it is one of the necessary components to SMB deals. So if you're buying a business, actively searching, new to the search space, this understanding of working capital is going to be the secret sauce to creating great deals. So it's very important to learn and understand what it is, how to calculate it, and why it should matter. Would like to see a quick poll of um, who's in the crowd today and where you are in your search process. So let me see if I can do a quick polling question. So where are you in your search process? Are you under LOI, actively searching? Um, what does that look like? Just started searching, where are you in your search process? Okay. Looks like we have a mixed group. Um, have some that say just started searching. One is under LOI, which we can get into a little bit later. Actively searching. Okay, so I'm going to end the poll. Um, Looks like we had a mixed bag of uh, a few folks under LOI, a few actively searching, and then some that are just started searching. So appreciate you, sharing those results. So what is working capital? What is it? Why does it matter? What does it look like? The realities are working capital in theory is a company's current assets minus its current liabilities. Um, Current assets, think things like cash, inventory, um, accounts receivable is a big one in small businesses. More often than not, uh, current assets are primarily going to be inventory, cash, and accounts receivable in small businesses. Current liabilities, think things like payroll, accrued expenses, rent, utilities, etc. And the calculation of working capital is the current assets less the current liabilities. That number equals what is your reported working capital. In small business acquisitions, there's a difference between reported working capital and working capital delivered at the time of closing. So typically, the way small businesses are structured is at the time of close, the transactions are structured on a cash-free, debt-free basis. So if you're a buyer, the seller will keep the cash in the business bank account. They will pay off any debts outstanding, and what is left is delivered to the new buyer at the time of closing. Now, I will say there's many mechanics of what that actually looks like, which is typically outlined in a purchase agreement. But in theory, that is how the exchange of working capital works. So, why does this matter? Like another way to understand working capital is some other examples. So current assets we kind of talked about, it's AR, inventory, other current assets. Current liabilities may have some short-term debt, payroll expenses, accounts payable. Uh, the difference is in things that are long-term. So when you're trying to understand working capital, it is the measure of current assets and current liabilities. Typically, think things that are less than 1 year. So payables that are required to be paid within 1 year. The 1 year test is good to understand the differences between short-term, current, and long-term assets and liabilities. Long-term assets and long-term liabilities are not included in working capital. This is because they're longer term in nature, and it's not appropriate for those to be exchanged at the time of closing. The transfer from buyer to seller. In asset purchases, you're buying, all of these things from the business. That is a different topic. This is strictly understanding how to calculate working capital for purposes of the exchange at the time of closing. So what is the working capital timeline when you think about small business acquisitions? So typically, during your pre-sale preparation, you want to analyze the historical working capital and monitor ongoing trends. Analyzing working capital, I typically will analyze it over a 12-month period, so the last 12 months. And then I will look at things like 3 months and 6 months analysis. From there, you want to negotiate in your LOI, defining the working capital methodology, understanding what is working capital going to be. This can be structured in the letter of intent or in the purchase agreement. For purposes of this timeline, if you can define it in the LOI, it would be preferred. Sometimes you don't have enough information to understand, and be comfortable documenting those. So the purchase agreement is fine. After you sign the letter of intent, this phase will be, your due diligence period. So you're going to conduct financial due diligence, legal, operational, and if you do arrive at the purchase agreement time, your M&A attorney, after you understand the components of the balance sheet, will establish the working capital terms. So you're going to establish this working capital target. The target is going to be based on the current assets and current liabilities that are defined as working capital. Whatever that number is going to be your working capital target. We're going to get into a few examples later on, so if this is a little confusing, I'll try to walk you through a simple example. From there, your transaction will close. Typically 30, 60, or 90 days following the transaction closing time, you're going to calculate what is called a post-close working capital true-up. You're going to calculate the same working capital using the same calculation. So if it was accounts receivable minus accounts payable, you're going to calculate that 90 days later using the same balance sheet accounts. And based on that number, you're going to compare it back to what is your working capital target at the time of the transaction close. And whether it's higher or lower, that has ramifications for whether the buyer owes more money to the seller or the seller is now owing money to the buyer, the old owner. So these are real dollars, and that's why it's good to understand a framework of the timeline. So 3 ways to calculate working capital, and these break it down into simple components. So you have something like the simple way, which is current assets minus current liabilities. You have the narrow method. This method excludes cash and debt. So this is like a typical SMB deal, which is cash-free, debt-free. So it's going to be, excluding cash and debt, which can be useful for coming up with, these working capital metrics in a cash-free, debt-free scenario. If you want to specifically call out working capital based on balance sheet items, you can do that as well. So if you only want working capital to be AR, inventory, less accounts payable, that's like a specific way to calculate working capital rather than taking the whole balance sheet. Again, in practice, best practice is to use cash-free, debt-free. So this narrow method is what I would prefer and recommend. So here's an example, and this is a real example of a consumer products business, which had 10 million of revenue.
So clean. It's insane.
And here's the balance sheet.
How much
So
you can do with this? It's crazy.
accounts receivable of 900,000, inventory of 1.3 million, prepaid expenses of 150,000. So I had current assets of about $2.3 million.
This is what we've uploaded.
Thinking back to our formula, working capital
And then you hit convert.
is current assets minus current liabilities. So if you turn over to the balance sheet, current liabilities consisted of accounts payable, liabilities, and deferred revenue.
Harmonies. You even have all these
After
presets that
taking current assets minus current liabilities, your working capital is $600,000.
Find a bunch of really cool harmonies.
$600,000 for a consumer products business
just my one vocal sample
is this space generates a larger amount of working capital
and it sounds
due to
real.
higher
Sounds
inventory and
authentic.
accounts payable balances. Typically, healthy consumer products businesses should generate working capital balances that is approximately like 8.5% of sales. So based on this information, this working capital target, if it was going to be used, may be appropriate.
There's an exciting new plugin that offers features that no one else has been able to offer before that may cause a change in the landscape. The new multi-streaming feature is part of
on the flip side, in the case of like a software business, given it's very low, it doesn't require a lot of working capital. It may not make sense to include something like that in your deal. Whether you include or exclude working capital, it's entirely up to the buyer and seller and what makes sense to them. So keep that in mind, when you are negotiating these things. So what is not working capital? When you think about working capital, it should not be cash available, to cover operating expenses, like, in the near term. Like certainly working capital continues the business to run as it's intended. Uh, in a cash-free, debt-free, transactions are typically cash-free and debt-free. Sellers keep the cash and they use some of that cash to pay off the debt at the time of closing. Working capital should be defined in the purchase agreement. The sooner you can define this, the better. So I'm gonna highlight this. The reason why you want to define it early in the process, so it's either in the LOI phase or it's in the maybe it's during due diligence, is sellers and buyers may have differences of opinion of what working capital should look like. For example, sellers think accounts receivable should entirely be delivered to them because they've already spent money to have labor produce these goods or purchased cost of goods sold in order to sell these goods. So they feel entitled to receiving all of the AR at the time of closing. The challenge with this is what they're saying makes sense. Like they produced, they spent money to generate these sales. Why not deliver, them the full AR amount at the time of closing and create some sort of clean break for the new buyer, the new owner? The challenge with that is if you don't have a certain amount of cash coming in the door, which typically if the transaction wasn't occurring, the business may develop a cash crunch. If you're not having cash available to cover, operating expenses in the near term, you need to think about other cash and sources and uses in order to produce, sustain the business operations. So, does the buyer want a lower or higher does the buyer want a lower or higher target working capital in the purchase agreement? This is a question I get asked frequently, and it kind of relates to your, gaming the system. I would say, in general, you want to calculate working capital in an amount that gives you the ability to sustain business operations. You shouldn't use working capital to materially inflate it in order to receive a price reduction. In practice, that doesn't work. That leads to lawsuits and litigation. So using working capital to target an appropriate amount is the best practice. In theory, with that being said, in theory, a buyer wants to target a higher level of working capital than what is perceived. So, for example, if you target $100 million as the appropriate working capital, if at the time of closing or during the true up phase, the amount that's delivered is less. So let's say it's 800,000. The seller would actually pay the buyer the difference. So this can, how does the seller pay the buyer the difference? These amounts can be held in escrow and exchanged after this lookup period is conducted. This can be used if there's a seller note, you can reduce the seller note by the difference. Work with an M&A attorney or a financial due diligence provider to understand how to target this and structure it in a way that benefits you, the buyer. When it comes to working capital, there are certain stipulations. So I'd love to hear some of your thoughts. If you have any questions about working capital or just deal making in general, feel free to ask away in the chat, and I'll get to those as quickly as possible. All right. So I'm gonna skip ahead past the higher or lower targeting of working capital. It's a little complicated. So I think some of the key takeaways, and this is a good example of um, the target versus what is actually delivered. So again, if the working capital is above the target amount at the time of deal closing, so you'll see on the left, the proceeds to the shareholder were $600. Um, if the working capital is below the target at deal close, so if um, you know, the target was 600 and the adjusted working capital was 550, it would be below it. Those proceeds, the difference is going to be returned back to the buyer. So when you're thinking about working capital, it's important to establish a target, based on some sort of historical average. So if it's over 3 months, 6 months, 12 months, use that trend in order to understand where you want to target working capital and think through your head after understanding the business if it makes sense. Another way to think about working capital is taking a look at the conversion cycle of the business, the cash conversion. So, how long does it take for sales to be collected? Is it 30 days, 60 days, 90 days? Uh, how long does it take for payables? So, how long do they pay, vendors? Do they have a net 30, 60, 90? Based on that information, you can use the cash conversion cycle to see if what you're establishing as a target makes sense. Set holdback amounts. So setting the money aside in a secure escrow is best practice. If there is like a working capital shortfall and you're owed money, you want to have that liquid cash available in order to draw on it to fuel the business. Um, if this money is not set aside and it's something that the old owner, will owe to the buyer, it's very likely you're not going to receive that money when you actually need it. It may be litigated. You may, and if you're going through the litigation process, this is a very long and arduous process. There's no guarantees you'll get that money in time to support the business operations if it was not in escrow. You want to define the true up period. So what's the timeline for these post-close adjustments? Are you going to meet in 60 or 90 days and talk about, conduct this true up period? The last one is including a collar. So setting a range where if it's above or below the target, no adjustment is made. I'm a little in the slide deck, so I'll try to fix that. But in practice, I've seen like plus or minus, 2% or 3% or 5%. That collar is set where no adjustment is actually made. And the reality of it is to give some buffer um, and wiggle room where, this ramifications of cash is not impacted. So, what are some of the key takeaways for working capital? working capital, you need to understand the historical trends, negotiate fairly, negotiating based on, what's the best interest for buyer and seller, why does it matter? These are important things in establishing a baseline for what's fair and reasonable. If the understanding in the agreement is not fair and reasonable, it's very likely this deal won't make it to closing, or there's going to be issues with how this is negotiated. I've seen it in practice quite often. So if you don't fairly negotiate working capital, this could lead to problems later on. Um, so with that, I'll close with one more item about working capital. So the working capital analysis is used to analyze this company's short-term financial health. It's the assessment of what's the operational funding that's needed on a day-to-day basis in order to sustain operations. When you're assuming duties as a new business owner, your objective is to maintain the operational functions of the business from the day before you transitioned as new owner to the first day. In theory, if we flip back to the car analogy, it's the gas that fuels the business. It is the tires on the car. So how do you conduct this analysis? By identifying seasonal fluctuations in the working capital, you can better assess what is the working capital needs of the business. Is it appropriate to use a 12-month average, a 6-month average, a 3-month average? Once you have an understanding of the business, it's easier to identify what is appropriate. Work with your CPA accountants if you're conducting financial due diligence. And this can ensure you have the adequate knowledge and resources to better understand the working capital, set an appropriate target, structure that target in the purchase agreement, and then work with an M&A attorney to make sure that language is binding in the event something triggers an escrow that you need to be paid or compensated for a shortfall. So that's working capital in a nutshell. When I speak with entrepreneurs and investors about small businesses and how I think about working capital, the way I look at it is understanding on a 12-month basis using the balance sheet, what is the reported working capital on a cash-free, debt-free basis. If there are working capital adjustments, so things like aged AR or other items that need to be adjusted, it either increases or decreases working capital. And from there, I will calculate a conversion cycle. So how long does it take for them to get paid? How long do they have to pay people? The cash conversion analysis is critical in that regard. And then from there, I calculate a target working capital and establish a 60 to 90-day escrow period for a look back analysis based on calculations in the purchase agreement. In practice, that is the most effective way to protect your downside risk as a buyer and ensure you're getting an appropriate amount of working capital from day one.